Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. By the time you see this, we will have launched our new website, which really streamlines the whole investing process. So please come check that out at investors.com.
Now this week on the show, we're going to talk about psychology in a downtrending market. And I think it'll be very useful. I think you'll like it. We're also going to talk about short selling.
Right, but during the weekend, you will be off to Florida.
Jacksonville, Florida. I'm going to be with the Gators.
Right, so we had to record this segment and the other segments of the show a little bit earlier, but we will have a market segment. Amy's off to Jacksonville, Florida this weekend for a leaderboard summit, so we recorded the rest of the show earlier in the week, but let's take a look now at how the market closed on Friday. I hope you've been wearing a neck brace to handle this continuing whiplash action that we've been seeing in the indexes. We started the new year, as we all know, with a decisive sell-off, and the heavy volume showed just how aggressive that selling was. But then look at the action on Wednesday. The Nasdaq sank sharply during the day, but managed to bounce back, going from a 3.7% intraday bloodbath to just a 0.1% dip. Then on Thursday, the market swung up and down, but ended essentially unchanged. And on Friday, the Nasdaq and the S&P both bolted higher. Here's what that looks like on the weekly chart. Hopefully, we'll see a turnaround relatively quickly, but be cautious about jumping back in too soon or too aggressively. No one knows for sure, but we're likely to see some head fakes before we see a decisive change in trend. And some lingering technical weakness includes how the 10-week line for both the Nasdaq and the S&P is below the 40-week line. And look at the volume. Trading has been much heavier on down weeks generally than on up weeks. We want to see the reverse of that to show more conviction for the long side on the part of fund managers and other large investors. The price of oil has had a major impact on the market. It fell below $27 a barrel earlier in the week, but managed to close around $32. Still, Schlumberger, the leading oil services firm, sees, quote, a deepening financial crisis in the exploration and production industry, unquote. It cut more than 10,000 jobs in Q4, and Halliburton and Baker Hughes have also cut tens of thousands of jobs. Now, the silver lining here is that strong new uptrends tend to begin when the news is gloomy and most investors and pundits are feeling especially bearish. So as we'll talk about later in the show, stay focused and don't get discouraged. And keep an eye out for stocks showing support and resilience. Starbucks closed the week well above its 40-week line after reporting on Thursday. While it missed on sales, it beat on earnings, and same-store sales growth in the Americas was a robust 9%. The coffee giant is also very bullish on China, where it plans to open 500 new stores this year with the goal of having 3,400 locations in China by 2019. The next test for Starbucks is the 10-week line, which has been acting recently like a ceiling of resistance. So see if it can convert that back into a floor of support as it tries to complete its current base. Now, Facebook also found support at the 40-week line and closed at the top of the price range. It's also back above its prior 96.59 buy point, but like Starbucks, it still needs to get back above that 10-week moving average. And Facebook just might get the spark it needs when it reports on Wednesday. As you can see here, it's a very busy earnings week with many market moving and some big name stocks set to report, including McDonald's, home builder D.R. Horton, and of course Apple, and then Alibaba, and we'll see how Amazon also did during the holiday season. Microsoft, Boeing, Amgen, and many other industry leaders are also set to report, so make sure you have your game plan in place this weekend. So as we all know, 2016 started out with a bust rather than a bang.
Yes, it
and
did.
It's very easy to get discouraged in this kind of market.
Yes, it is.
So today, we're going to talk about the 4 Ps that can help you keep your portfolio and your psyche intact as we weather this storm.
And quite a storm it has
Yes.
been since the first of the year. But we've been saying for a really long time that we've needed to correct. Even a bear market would be just fine because
Right.
we will find a fresh crop of leaders after that. So the 4 Ps are going to be to protect your capital, to stay positive, to prepare for the next bull, and profit from the big winners that will come in the next bull market cycle.
So let's start with the first P, which is to protect your capital. When the indexes start to roll over from an uptrend into a correction, you need to take some defensive action and reduce your exposure. And that certainly happened last month as the NASDAQ started to show signs of fatigue. It fell below the 10-week line, tried to reclaim it, then rang in the new year with the sharp decline. As you see that kind of action happening, you need to have a plan to protect your money and then to actually execute that plan.
Now, Apple had been a bellwether for the overall market for a fairly long period of time, but nothing goes up forever. So back in July, Apple began struggling, and it really pulled back with the overall market in August. It gained some traction before rolling over again with the general market choppiness, and it sold off further when the market was tanking. Apple was an early clue that the overall market was getting into shaky ground, and it was time to protect capital and keep a close eye on stocks that you may have owned at the time.
That's right. Now keep in mind that you're not just protecting your money, you're also protecting your confidence, and that is incredibly important. So if you watch gains turn into losses and you feel like you're at the mercy of the market, your mindset can become your own worst enemy. And that leads us to the second P we want to discuss, which is to stay positive in a down market.
And we know how frustrating or difficult this can be. It's easy to say, hey, just have a positive attitude, really good outlook.
But look at my stocks.
Yeah, well, look at the market tanking down 500 points before it bounces. But, it really is a positive thing that we're seeing the market pull back. We don't know what will come, but it is definitely positive. Now, Bill O'Neill never, ever let the market turbulence affect his mood. He's always pretty cheery no matter when you see him, when you talk to him. So staying in balance and keeping a level head is really important if you're going to survive as an investor.
It really, really is. Now, if you become overly negative and frustrated, you lose your sense of perspective and you may start to make some rather hasty and really emotional decisions. So if you're not in the right frame of mind right now, step back, maybe take a walk, regroup. And just to reiterate as we get to the next P here, it's much easier to stay positive if you followed the first one, which is to protect your money.
Now, which brings us to the P, which is to prepare. And this is the exciting part, really. I want everyone to get excited, getting prepared to make some really big money in the next bull market cycle. The money, the most money is made the first 2 years.
That's right.
So you want to study right now and prepare so you can make a lot of money when we start a new uptrend. Now, we showed Apple falling apart, but what's pretty thrilling is to see how it looked after we had a bottom in March 2009. It ran up 29 weeks with only like 6 little pink weeks. It basically didn't go anywhere. It didn't give up ground. And during those weeks, it just hardly moved. So that's exciting. Be excited about that. Apple went on to make a massive move, and that's what you should prepare for now. Study the past leaders so you can capture them in the future.
Right. Now, one key to preparation in a down market is to always keep building and updating your watch list. Last week we talked about 5 different ways that you can see how well a stock is holding up, showing resilience in a market. That's a good place to start. You can also do a post-analysis during a correction to improve your skills and help you get ready for the next uptrend. And we have information on how to do that on our website as well.
In a normal market, and we will get one of those again, we promise, some investors can take profits around 20 to 25% because history's shown us again and again that that's about how much a stock runs up before it forms another base or a price consolidation. But in markets such as maybe last year and maybe this year, taking profits sooner, say at 10%, has been sound advice. Now with the market sell-off, hopefully investors can prepare to take some bigger profits, and that is exciting to think about, making money again more easily.
It'll be nice when we have a nice uptrend again.
Yes.
So not to sound too Pollyannish about this, but it really does help if you keep these 4 Ps in mind in the current market. First, you want to take steps to protect your money and your confidence. Then stay positive and keep preparing. Don't walk away from the market. That is one of the biggest mistakes people make. When it's down, they just walk away and ignore it. And then get ready to profit when a new bull cycle eventually rolls around.
Would you like an edge that helps you pick winning stocks faster an edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you bases, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
Well, with the market pulling back sharply, we figured now would probably be a good time to talk about shorting. Now, I know a lot of folks out there are not comfortable with it, but a lot of former leaders correct on average 72%. So what goes up comes down, and there's going to be a lot of potential shorts in this market
If we do go into a full bear cycle.
If we do really roll over.
Right. Well, let's start with a quick definition. Short selling is basically the process of selling borrowed shares of a stock in hopes of buying it back later at a lower price and then pocketing the difference. But there are potential pitfalls to shorting. Don't kid yourself about that.
More tricky than the long side.
It really can be. So today we're going to look at 5 keys to successful short selling. And as a word of caution, note something that IBD founder Bill O'Neill wrote in his book, How to Make Money Selling Stock Short. There are 2 sides to everything except in the stock market. In the stock market, there is only one side, and it isn't the bull side or the bear side, but the right side.
Which side are you on? Are you winning or are you losing?
Absolutely.
All right, the first essential thing you want in place for short selling in order for it to really work is a downtrending market, one that is in a correction like we have in the current environment. And the reason for that is most stocks follow the general market trend. So in a downturn, it's more likely that the majority of stocks will follow downstream together.
Right, and as we go through these 5 factors, you're going to see that shorting stocks is basically the mirror image or the reverse of what you want to do on the long side.
You just flip everything upside down.
The second point for shorting is to focus on stocks that have already made a huge move, typically 300% or more. As an example of that, let's use Ambarella.
Now, Ambarella is a chip supplier for surveillance cameras as well as GoPro, and the stock made a massive move, starting with its IPO debut in October 2012. The market was healthy. We had an exciting new IPO, and around May of 2013, look at the massive volume that came into the stock. The institutions were just starting to pile in.
Right, so Ambarella had the type of massive move you want to see in a stock before you short it. Trying to short a big growth name after it's only gone up, say, 25-30% in a still uptrending market, that can quickly backfire on you. Now, here's a third factor. Focus on highly liquid, not thinly traded stocks. Around the time that Ambarella started to fall apart and become a potential shorting candidate, it was trading over 2.2 million shares a day on average at a share price of about $120. So it definitely qualified as a liquid stock.
Now, being in a very liquid stock, yes, this is extremely important because you don't want to get caught in a short squeeze. And then what do you look for? Well, some easy things to spot. The evidence that the stock is beginning to break down, that the party is over. It's made this massive move. So first, we're looking for a really sharp break of the 50-day moving average or the 10-week on massive volume, showing heavy institutional selling as the pros head for the exits. Former big leaders in previous bull market cycles are bought heavily on the way up, and then they are sold heavily on the way down.
Sure.
And many of those stocks will have formed later stage bases, and they will eventually break down.
And you can see that change in Ambarella in August 2015 as it crashed below the 10-week line. Now, here's another example that we want to look at. In November 2014, Keurig Green Mountain had risen almost 400% from a breakout 2 years earlier. Then it started to run into trouble. On the week ended November 21st, 2014, it fell over 9% on volume 124% higher than normal. But it was still testing that key 10-week line. So shorting at this point, given what you knew at that time, was still risky because it certainly could have bounced back.
And from there, Green Mountain Coffee Roasters was literally living beneath the 10-week line, and it just could not get back above it. And this was a former big leader. It had made a 1,000% run that started in March 2009 at the beginning of a new bull market cycle. Now, it was seeing increased competition from other coffee makers. Earnings were slowing. The RS line was beginning to roll over. It was just a sign that this former leader was no longer a market leader at that time.
Right, and Green Mountain ended up forming a head and shoulders pattern. Now, when you're buying a stock on the long side, you look for the stock to form a cup with handle or some other bullish pattern. And on the short side, the head and shoulders is a bearish pattern that you do like to see. Now, you have the left shoulder here, then the head, and then the stock forms the right shoulder.
And in terms of profit taking, which is the fifth element to consider, there were several spots. Now, one profit target is 20 to 25%. In a more choppy market, consider taking profits at maybe 10%. In the case of Green Mountain, you could have let your short run further because once this stock started to drop, boy, did it drop fast and hard.
Which happens a lot.
Yeah, when they go, sometimes they go. And this big drop came from a later stage base after a long run for this stock, which really lasted several years.
Now, that's a very quick overview of short selling. There's obviously a lot more to learn. And you can find out more by looking at the Investors Corner series we just did on short selling, which you'll find on our website. And you can also check out IBD founder Bill O'Neill's book, How to Make Money Selling Stocks Short.
And we also have home study kits on short selling. They cover this in more detail, of course. And Leaderboard also has a cut list of stocks that are in shorting territory. And you can take a trial of Leaderboard to see that particular list. So you'll find a link to all these things on our site at investors.com/investingshow. I will be in Atlanta next weekend, so be sure to come and see me.
Right, and you can learn more about short selling, as we mentioned, on our website, and check out the whole new, completely revamped investors.com, and you can see show notes at investors.com/investingshow.
Okay, see you next week, everybody.